There's a pattern that's predicted every major financial crisis for the past 50 years. Not most of them, every single one. And right now, it's flashing red again. In 1929, it appeared 18 months before the crash. In 2000, before the dot-com bubble burst. In 2006, before the housing crisis. And each time, experts said, this time is different. Spoiler alert, it never is. Today, I'm going to show you what this pattern is, why it works with terrifying accuracy, and why what's happening right now is the most dangerous version yet. Let's start simple. Would you rather lend someone money for 2 years or 30 years? Obviously 30 years, right? Because the longer your money is tied up, the more risk you're taking. This is how the bond market normally works. Long-term bonds pay higher interest rates than short-term bonds. It's called the yield curve, and it slopes upward, but sometimes that curve inverts. Short-term rates climb higher than long-term rates, and when that happens, a recession typically follows within 6 to 18 months. Why? Think about what it means when investors accept lower returns for 30 years instead of 2 years. They race saying, I am so worried about the near future that I'll take less money, just for long-term safety. It's not a technical indicator. It's mass fear disguised as market data. January 1928. The roaring 20s are in full swing. Stocks have been climbing for years. Everyone's getting rich. The yield curve inverts. Nobody notices. Why would they? You can buy stocks by putting down just 10% and borrowing the rest. It's the easiest money anyone's ever made. 18 months later, October 1929, Black Tuesday arrives. The crash happened because banks had lent billions to stock speculators who used borrowed money to buy more stocks, which pushed prices higher, which made banks lend even more. When prices started falling, banks demanded their money back. Speculators had to sell. Prices dropped further. More margin calls, more selling, a debt spiral. The yield curve didn't cause the crash. It detected the instability everyone else refused to see. Fast forward to 2006. Housing prices are skyrocketing. Banks are giving mortgages to anyone. Wall Street is packaging these mortgages into securities with AAA ratings. The yield curve inverts in late 2006. Again, nobody cares. Real estate never goes down, right? These securities are safe. The rating agencies said so. 2 years later, Lehman Brothers collapses. Bear Stearns disappears. The entire global financial system nearly shuts down. The pattern was identical to 1929, just with different assets. Once again, the yield curve had warned anyone willing to listen. The yield curve inverted in 2022. If history is any guide, we should be watching for problems right about now. But this time, 3 factors make the situation more dangerous than anything we've seen before. First, the scale of debt. In 1929, total U.S. debt was manageable. In 2008, it was higher but still within norms. Today, we're drowning. The U.S. government owes over $35 trillion. Corporate America has borrowed another $10 trillion. Consumers owe $17 trillion. This isn't just bigger than previous crises. It's bigger than anything in human history. Second, the speed of contagion. In 1929, if a bank failed in New York, it took days for panic to spread. In 2008, electronic trading meant hours. Today, we have algorithmic trading executing millions of trades per second. Cryptocurrency markets that never close. Derivatives existing only as computer code. When the next panic hits, it'll travel at the speed of light. Third, and this is the big one, central banks have already used all their ammunition. After 2008, the Federal Reserve cut interest rates to near zero and printed trillions. This was supposed to be temporary emergency medicine, except the economy never healed. It got addicted to cheap money. For over a decade, rates stayed near zero. Instead of fixing problems from 2008, they created new bubbles in everything. When COVID hit, they doubled down. More printing, more stimulus. Now here's the terrifying part. Those tools don't work anymore. Interest rates are already low. Government debt is already dangerous. The Fed's balance sheet is already bloated. So when the next crisis hits, what weapons do they have left? Think about what this means practically. Your retirement account is in a market inflated by cheap money. Your home's value has been pushed up by rates that can't stay low forever. Your job might depend on a company borrowing at artificially low rates to stay profitable. The entire economy is built on debt and printed money, and the yield curve is warning that this foundation is cracking. Every time the yield curve inverted in the past, people said this time is different. They were always wrong. In 1928, they said the economy had entered a new era. In 2006, They said real estate only goes up and financial engineering eliminated risk. Today, I'm hearing the same phrases. The economy is strong. The Fed knows what it's doing. Maybe they're right this time. Maybe the pattern that's held for 50 years will suddenly break. Maybe we've figured out how to borrow unlimited money without consequences. But I wouldn't bet on it. The yield curve doesn't care about optimism. It's just math and human behavior. And right now, it's screaming that something is very wrong. History doesn't repeat, but it rhymes. And the rhyme we're hearing today sounds a lot like 1929 and 2008. The question isn't whether another crisis is coming. The yield curve has already answered that. The real question is, what happens when it arrives and we've already spent all our ammunition fighting the last war? Every major financial crisis in modern history was preceded by the same warning sign. That warning sign is flashing right now. You can ignore it, like investors did in 1929 and 2008. Or you can look at the pattern, understand what it's telling you, and prepare accordingly. Because when the yield curve speaks, history suggests you should listen.